France has one of the most equal societies in the developed world. America has one of the most unequal. Yet the average American still earns far more than the average French citizen. So here's the uncomfortable question. If inequality is such a major economic problem, why is the more unequal country richer? Why haven't countries like France simply copied the American model? The answer reveals one of the most misunderstood ideas in economics. Every economic system is a set of trade-offs, and different countries simply choose different ones. Alex works 35 hours in Lyon. He gets universal healthcare, 5 weeks paid holiday, strong job protection. Meanwhile, Jake in Texas earns nearly twice as much. One lives in a more equal society, the other in a richer one. So which system actually works better? And why haven't countries converged on one answer? Because economics isn't about perfection, it's about trade-offs. France has lower inequality than the United States, but Americans are still richer on average. That sounds like a contradiction, because we usually assume a fairer distribution means a better outcome. Yet on mainstream measures, the United States produces noticeably more output per person, even after adjusting for prices. So the real question is not who is right. It is what is each country trading off. And if equality is bad, why does the more unequal country end up richer? To answer this, we need to start with something boring: definitions. Because the entire debate changes depending on which metric you choose. The first metric is the Gini coefficient. It's a summary measure of inequality. Think of it like a single number that compresses the whole income distribution into one score. In the World Bank's formulation, it's an index from 0 to 100. 0 means perfect equality. 100 would mean one person earns everything while everyone else earns nothing. On this measure, France sits around 31.8. The United States sits around 41.8. And that's not a small gap. It is the difference between a more compressed European income distribution and a far wider American one. But then we have income itself. GDP per capita is not a household paycheck. It's a total production divided by population. It is one of the best single number summaries we have for how rich a country is on average, especially when we adjust for different price levels. On a purchasing power basis, the United States sits well above France. So the paradox is real. More inequality in the US, more average income in the US. Now, we also need a typical person measure. That's where median income comes in. The median is the middle. Half earn more, half earn less. This matters because inequality can pull the average upwards. A high average can hide a weak middle, and a low average can hide a strong middle. Finally, in rich countries, the most common poverty measure is relative poverty, not starvation, but falling far below the living standards considered normal in that country. The OECD defines the poverty line as a 50% of the median household income. So poverty in a rich country can rise even if nobody is living on a few dollars a day. It's about position inside a society, not just calories. Now we can actually compare systems. How does France reduce inequality? Not through one policy, through a whole architecture. Start with taxes and transfers. France collects a very large share of national income in taxes, among the highest in the OECD. The United States, by contrast, sits far lower. That gap is enormous, and it funds a welfare state that is also enormous. France spends heavily on public social protection, healthcare, and income support. Now add labour policy. France does something that sounds simple, but has big effects. It compresses wages from the bottom. Its minimum wage is high relative to the median wage. That means the floor is closer to the middle, so the low end can't fall too far behind. Of course, the trade-off is that when you raise the wage floor above the productivity of some workers, some jobs can disappear, unless the government offsets the cost or the economy shifts towards the higher productivity work. France does use exemptions and subsidies around low wages to manage that pressure. Employment protection also matters. The United States is one of the least restrictive major economies when it comes to dismissal and labour flexibility. France is more regulated and rigid. That changes bargaining power, turnover, and risk. France spends much less for personal health than the United States. For households, the French system usually feels more predictable. In a more universal system, health costs are less likely to become a private financial shock. Put these together and you get France's result: a smaller spread of market wages, a larger tax and transfer system, and more social insurance that reduces downside risk, which shows up as lower measured inequality. So why is America richer? Again, not for one reason, but the simplest explanation is that the US turns more inputs into output. Americans work more hours per worker than the French. That difference is not minor. It's hundreds of hours a year. And if productivity per hour were identical, working more hours would raise output per person. Second, productivity per hour is also higher in the US, though not by an order of magnitude. That gap stacks on top of the hours gap. Third, innovation and capital. The United States invests heavily in research and development. Higher R&D does not guarantee growth though, but it is strongly associated with more frontier industries, more patents, and more high output sectors. The ecosystem for funding risky growth is also larger. The US has a much larger venture capital market. And that matters because venture capital is one of the machines that turns new ideas into scalable companies. When it is abundant, you get more hits. You also get more inequality because the rewards of hits are not evenly distributed. This brings us to a central point. Higher incomes at the top can raise overall averages, but they also widen the distribution. So a country can look simultaneously richer and more unequal. That is not a moral judgment, it's arithmetic. But being richer matters for another reason, and it has nothing to do with household shopping baskets. A bigger GDP does not just mean more money in the economy. It means more national capacity. It means more ability to act. A richer country can fund a larger military without breaking its finances. It can absorb shocks more easily. It can spend more in a crisis. It can sustain bigger research budgets. It can attract more global talent. And, over time, it can shape the rules of the world around it. This is one of the hidden advantages of growth. When an economy becomes much larger than its peers, the gap doesn't just show up in pay packets. It shows up in defense, in technology, in finance, in diplomacy, and in influence. A country with a bigger economy can bankroll more scientific research. It can support more universities. It can finance more startups. It can attract more engineers, scientists, and entrepreneurs from the rest of the world. That creates a feedback loop. Growth attracts talent. Talent creates innovation. Innovation creates more growth. The same is true of geopolitics. Large economies tend to have deeper capital markets, more stable currencies, and more influence over global standards. They get more say over what technologies scale, what financial rules dominate, and what alliances matter. That does not mean GDP is the same thing as quality of life. It isn't. A society can be rich and still be stressed, unequal, and insecure. And a society can rationally choose more equality, more leisure, and more stability over chasing maximum growth. France, to some extent, has made that choice. But long-run growth compounds. And when it compounds for decades, the result is not just a richer country, it's a more powerful one. So when we compare France and America, we're not just comparing two ways of dividing income, we're also comparing two different levels of national capacity. So now let's put two fictional workers into these systems. Meet Claire. Claire works full-time in a retail job outside Lyon. Her pay is not high, but it is buffered by a system designed to reduce downside risk, minimum wage rules, unemployment protection, and subsidised healthcare. Her income is more predictable. Her unemployment risk may be lower once employed, but her chance to jump into a high-paid, fast-growing tech firm is also lower, partly because France has fewer of those firms per capita, and partly because the labour market is less fluid. Now, meet Marcus. Marcus works in logistics in Texas. His wage might be higher than Claire's in absolute terms, especially if he works longer hours or overtime, but his system tends to place more of life's risks on the household. Healthcare costs can be complicated, job loss can be sharper, local costs can vary a lot. On the upside though, if Marcus moves into a high productivity sector or takes a risk that pays off, the US system tends to reward that jump more aggressively. So Marcus faces a different deal. More upside, more downside. These are not stereotypes. They are the results you'd expect when one system emphasizes insurance and compression and the other emphasizes dynamism and market rewards. Now the trade-offs show up clearly in labour outcomes. Youth unemployment is a stark example. France has a much higher youth unemployment than the US. That does not mean young French people don't work. It means entry into the labour market is harder, and the transition can be slower. If you're already securely employed, France can be protective. If you're trying to get your first stable foothold, the system can be less forgiving. Another trade-off is health spending. The US spends far more. That can buy access, technology, and capacity in some areas, but it also means inefficiencies, and who pays questions become a major part of household economics. France spends much less and yet covers broadly, which is part of why measured inequality and household risk can be lower. And then there is redistribution. France's lower inequality is not an accident. It's a policy choice that shows up in poverty and distribution of disposable income. But again, it comes with costs, especially tax burden and labour market frictions. At this point, it is tempting to ask which system is better, but the question assumes there is a system that maximises everything. In reality, systems don't work like that. You can push on inequality with redistribution and regulation, and you will often reduce risk and raise stability. But you may also reduce flexibility, raise tax burdens, and slow some types of growth. You can push on dynamism and market rewards, and you will often get more innovation and higher output. But you may also get a wider spread, higher exposure to shocks, and weaker insurance for the unlucky. Economics rarely offers perfect solutions. It offers trade-offs. So what is the key insight? It's not France succeeds and America fails, and it's not the other way around. It is this. The United States is richer on average, France is more equal. And those two facts can coexist because they are produced by different policy priorities. Part of America's higher output comes from working more hours, sustaining higher return sectors, and building a bigger engine of innovation. Part of France's lower inequality comes from compressing wages, redistributing more aggressively, and socializing more of life's risks. And in the middle, for real people, the best system depends on what you fear most. Do you fear low mobility and a weak safety net? Or do you fear low growth and high barriers to entry? Do you want more equality, even if that means a smaller upside? Or more dynamism, even if that means a wider spread of outcomes? Once you frame it that way, the paradox seems to disappear. Inequality tells us how income is divided. Growth determines how much income exists to divide. And over long periods, bigger economies do not just produce more wealth, they produce more power. So the real question isn't which country is better, the real question is, which trade-offs are you willing to accept? More equality, more insurance, and more stability, at the cost of higher taxes and a less flexible labour market. Or more growth, more upside, and more dynamism, at the cost of higher inequality, greater household exposure to risk, and a wider spread of outcomes. France and the United States are not running the same economic experiment. They are optimizing for different outcomes, and the data is simply reporting the result. Economics isn't about good ideas versus bad ideas, it's about trade-offs. If you want more clear thinking about the forces shaping our world, consider subscribing, and remember, always follow the incentives.